What if you could get a really clear picture of the huge commercial real estate market, like
Yeah.
straight from a major global player, CBRE, without needing to wade through, endless financial reports? Well, that's what we're aiming for today.
Exactly. We're diving into CBRE Group's second quarter 2025 earnings call and their press release. These are really direct sources. They give us a firsthand look at how different property sectors are doing and, well, CBRE's own strategy.
Our mission here is pretty simple. Unpack the main findings, point out maybe some surprising details, and just help you understand what's really driving things in commercial real estate right now.
Think of it as your fast track to getting up to speed on property trends, investment flows, and how businesses are dealing with, let's face it, a pretty uncertain economy.
Okay, so with that setup, let's jump into the headline figures. Because CBRE's Q2 performance really sets the scene. The big theme that just jumps out is resilience.
hmm
Despite all the background noise, the macroeconomic uncertainty, they showed really strong momentum carrying through from Q1 into Q2.
Yeah, it seems their clients, both occupiers and investors, mostly just, well, got on with their plans. And what's really interesting is how that resilience showed up in the numbers. Both their resilient businesses, the steadier recurring revenue streams, and their transactional ones saw strong double-digit revenue growth.
But the resilient ones actually outperformed, right?
Exactly. Resilient revenues were up 17%, which actually beat the 15% growth for transactional. That's significant. It shows real progress in those more stable segments, making them less dependent on just the big deals.
And the bottom line numbers really hammer that home. We're talking core EBITDA up 30%.
Huge.
And core earnings per share, core EPS up a massive 47% in the quarter.
Wow.
Overall revenue jumped 13% to $9.8 billion. That's quite a leap in this climate.
It really is. And because of that performance, CBRE actually raised its forecast for the full year. They're now expecting core EPS between $6.10 and $6.20. That's better than 20% growth, the midpoint.
And that's driven by Q2 doing so well, and they see strong pipelines ahead.
Precisely. The Q2 beat plus what they see coming gives them that confidence.
What's maybe most remarkable is that they expect to hit a new earnings peak in 2025. That's just 2 years after the big downturn trough in 2023. And they're saying this even though capital markets, like property sales, are still way below previous peaks.
Yeah.
So what gives them that confidence if a big driver like capital markets isn't fully back?
Well, it goes back to that strategic shift we mentioned, focusing on the resilient side, plus really good execution on integrating businesses they've acquired. It highlights how crucial things like facilities management, project consulting, and investment management have become.
So even if deal volume is lower.
Right, the basic need for well-managed buildings, for advice, for services that's still very much there. And they've tapped into that consistent demand really effectively.
Okay, let's dive into those segments then. Starting with advisory services, they called it an excellent quarter.
Yeah, revenue up 14%, and segment operating profit SOP grew 31%. Very strong.
And digging into advisory, global leasing was apparently the highest Q2 ever for them.
That's right, up 14% globally.
Hmm?
In the U.S., also up 14%. But interestingly, the office sector led that with a 15% increase.
Office, still strong then.
Apparently so, driven by larger leases. And it wasn't just concentrated in a few spots. It was pretty broad-based across the country.
And you mentioned something about non-gateway markets outpacing the big cities.
Yes, exactly. Growth outside the major gateway markets was faster. So it suggests momentum isn't just in the New Yorks or San Franciscos, it's broader.
Okay, interesting. What about industrial leasing?
That was better than expected, too. Revenue up 15%, mainly driven by third-party logistics companies, 3PLs.
Makes sense with supply chains and e-commerce.
And internationally, EMEA, Europe, Middle East, Africa led the way with 18% growth, mainly UK and Germany. Asia-Pacific was up 12%, with India and Japan doing well.
So looking ahead for leasing, the comparisons get harder later this year, right?
They do. But they still expect office leasing to grow at a mid to high single-digit rate. They talked about this return to the mean after COVID. Companies are using offices again to connect employees, boost productivity, build culture.
Right, redesigning spaces for collaboration, not just desks.
Exactly. The potential challenge they mentioned, though, is maybe not enough supply of the right kind of space in some areas.
And industrial leasing, the outlook there.
Also improved. They now expect roughly double-digit growth for the full year 2025. Still very strong demand.
Okay, let's shift within advisory to capital markets. This often reflects investor confidence. What happened there?
Well, global property sales rose 20%. That was better than expected and faster than Q1,
And in the U.S.?
up 25%.
Hmm.
Particular strength in data centers, office surprisingly, and retail. They said July sales were very strong, though maybe a slight dip in May and June.
And internationally?
Also strong, especially India and Japan, driving APAC up 24%. EMEA was up 19%. They did caution, though, that European sales might slow a bit in the second half.
What about the debt side? Mortgage origination?
That was up over 40%. Really strong volumes from the GSEs, Fannie Mae, Freddie Mac, and also debt funds and CMBS lenders.
Wow, 40%. So what's the outlook for capital markets overall then? Still strong?
Yeah, they expect sales and refinancing to stay pretty active in the second half. They don't anticipate major interest rate changes messing things up. And crucially, they said the gap, the spread between bid and ask, has basically closed.
Meaning buyers and sellers are agreeing on price more easily.
Exactly. That unlocks deals. Plus, there's apparently a lot of capital still looking for real estate, and owners who couldn't sell before are now more interested. And lots of loans still need refinancing.
Okay. And the other smaller advisory bits like loan servicing and valuations?
Also solid. Loan servicing revenue up 1%, portfolio at $443 billion, valuations up 7%, mostly in the U.S. It just shows the breadth of that advisory segment.
Right. Okay, moving beyond advisory, let's talk about the operational side. Building operations and experience, or BOE. How'd that do?
Really strong. Top-line growth of 18% and SOP growth of 21%.
What's driving that?
Well, their enterprise business serving large companies saw good new wins and expansions, especially in tech, healthcare, industrial, and continued really strong growth with hyperscale data centers.
Data centers keep popping up.
They do. And their local business also saw double-digit growth, led by the UK, which is their biggest market there, and the US.
Property management revenue was up 30%. That seems huge.
Yeah, a big chunk of that boost came from Industrious, the flexible workspace company they bought in January. That acquisition clearly kicked things up a notch.
And they're looking for synergies across that massive portfolio they manage, like 8 billion square feet.
Absolutely. They're actively looking for ways to be more efficient by standardizing things like building engineering, procurement, across that huge scale. Some benefits started showing up already, but they expect the really big operating leverage gains from these initiatives to hit more in 2026, in terms of longer-term play on their scale.
Got it. Another growth area was project management. Revenue up 13%, SOP up 18%.
And a big story there is the integration of Turner and Townsend. That seems to be going really well about 6 months in.
How so? What did Turner and Townsend bring?
Well, their original legacy business saw mid-teens revenue growth pretty much everywhere, especially strong in the UK. And this was important because while the legacy CBRE project management side grew too, Turner and Townsend added significant resilience, especially when some clients were maybe getting nervous about the economy and pausing projects.
So it smoothed things out. How are they actually getting benefits from putting these two together?
A few ways. One is resource optimization. They now have this pool of 15,000 project managers, cost consultants, etc., and they can move people where the work is.
So shifting people from a slower legacy CBRE team to a busy Turner and Townsend project.
Exactly. Big efficiency gain. Plus, they're adopting Turner and Townsend systems, technical platforms, timesheets, trainings, which are apparently very efficient and help margins.
And that's leading to new business.
Yeah, they mentioned being able to offer Turner and Townsend's expertise to existing CBRE clients has already won them large new contracts, including for facilities management and for their development arm, Crammell Crowe.
So it's like 1 + 1 = 3, kind of?
That's the idea. They called it a very, very different, more compelling business emerging.
And the outlook, they expect these synergies to keep building.
Yes, over the next couple of years. For this full year, they expect low double-digit net revenue growth for the combined project management segment. It really fits that story of building a more robust, service-heavy company.
Okay, let's switch gears to real estate investments, REI. How did that segment perform?
Operating profit there was up a lot, 150%, but that was against a pretty easy comparison from last year, and it was broadly in line with what they expected.
Within REI, what about investment management, the AUM?
Assets under management, AUM, finished Q2 at $155.3 billion. That was up $6.2 billion from Q1, mostly because of favorable currency movements, actually.
And the revenue for managing that?
Recurring revenue grew 5%. They said some investors are still a bit cautious, but they do expect capital raising to keep picking up, building on momentum from the last couple of years. So again, that recurring element is key.
And the development side? Trammell Crow?
Operating profit there was also in line with expectations. Most of the actual asset sales, including some data center sites they're developing, are expected later in the year, mainly Q4. The potential profit baked into their current pipeline is holding steady at around $900 million on a portfolio worth about $31.7 billion. So a solid future pipeline.
You mentioned data centers again, and there's this infrastructure angle too, right?
Yes, this is quite interesting. They have a growing infrastructure fund, about $10 billion in AUM. And remember, Turner & Townsend works on huge infrastructure projects, nuclear plants, airports, data centers, energy projects.
Right.
Trammell Crow is developing data center land. And CBRE itself manages or does project work in, like 700, 800 data centers.
So they're really leaning into infrastructure.
It seems so. They're actively looking for new investments to grow their exposure there. They called it a nice dimension to their overall market opportunity. It's definitely a strategic expansion.
Okay, so the business units are performing well, shifting towards services.
Yeah.
What about the company's overall financial health? Liquidity, debt.
Very strong position. Total liquidity went up by $1.2 billion in the quarter to $4.7 billion.
How'd they manage that?
Partly through a $1.1 billion bond offering, and they also expanded their revolving credit facility, so a nice safety cushion.
And cash flow, are they generating cash?
Yes. Free cash flow was technically only $2 million in Q2, but that reflected some timing shifts between Q1 and Q2. More importantly, their trailing 12-month free cash flow was nearly $1.3 billion,
Okay.
and they expect over $1.5 billion for the full year 2025, converting profits to cash quite efficiently towards the high end of their 75–85% target range.
So lots of cash coming in.
Yeah.
What about debt levels?
Very manageable. Net leverage was just under 1.5 times EBITDA at the end of Q2, well below their limits. They actually expect to end the year around just 1 times net leverage, assuming no big acquisitions.
Speaking of acquisitions, how are they thinking about using that cash? M&A versus buybacks.
They said M&A is the priority. If they don't find the right deals, they'll fill in with share buybacks. They've already bought back $663 million in shares since the start of the year.
And the M&A focus is pretty specific, isn't it?
Very. They're focused on resilient and cyclically favored businesses. So more services, less transaction dependent. They want well-run companies with new capabilities that can be worth more inside CBRE than on their own.
And they explicitly said no M&A in advisory capital markets.
Correct. They're not looking to buy traditional brokerage or sales businesses right now. It really underlines that strategic shift we've been talking about.
Okay, so let's pull this all together. What does this deep dive into CBRE's Q2 really mean for you, the listener, trying to make sense of the commercial real estate world?
Well, I think first, you see a major company successfully navigating a really complex, uncertain environment. It shows how focusing strategically on diverse, resilient service lines and integrating acquisitions well can drive growth even when traditional markets are choppy. It's kind of a playbook for adapting.
Yeah, and you also get some specific, maybe even surprising market insights, right? Like the unexpected strength in office leasing, the ongoing power of industrial, the pickup in property sales and lending.
And the clear strategic importance of data centers and this broader infrastructure play, it shows where the smart money and strategic focus are heading.
And finally, I think the integration story, especially with Turner & Townsend, is really telling. It shows how combining capabilities in these large professional service firms isn't just about adding revenue. It's about unlocking totally new efficiencies and growth opportunities.
Absolutely. So the biggest takeaway for me is that strategic pivot to resilient businesses, coupled with effective integration. It's working. They're generating strong results, even with capital markets below peak. It really demonstrates the power of having that diversified strength in services and investments.
It leaves you with a provocative thought, doesn't it? As companies like CBRE put more and more focus on these resilient facilities management, project management, expanding into infrastructure, does this signal a real long-term shift for the whole industry? Are we moving away from being so tied to those traditional boom and bust transaction cycles towards something more stable, more service-based?
That's a fascinating question. It could fundamentally change how we think about the commercial real estate sector over the next decade. Something definitely to keep watching.